Japan just pulled a move that caught everyone off guard, and now the US stock market is feeling the heat. When Japan's central bank decided to hike interest rates, it wasn't just about shaking up their economy, it sent shockwaves around the globe, especially to Wall Street. Investors in the US are now on edge and markets are reacting in ways few expected. So what exactly did Japan do? And how did it manage to throw a wrench in the gears of the US stock market? Let's break it down. To understand how we got here, we need to look at Japan's economic situation over the last few years. For decades, Japan had been stuck in a low interest rate environment. They even experimented with negative interest rates at one point to try and jolt their economy out of stagnation. It was a gamble, but one that Japan's policymakers were willing to take to avoid deflation and encourage spending. However, as inflation started creeping up globally, Japan found itself in a tough spot. Their currency, the yen, was weakening, making imports more expensive, and the cost of living was rising. The Bank of Japan, known for its cautious approach, made a surprising decision in 2024. It decided to start raising interest rates. What seemed like a modest 0.25% hike might have been a small number, but it was a big deal for global markets. But why does this matter to the US? Well, Japan is the world's third largest economy. Any significant policy shift there ripples out globally, and that's exactly what happened when they started tinkering with their monetary policy. As Japan's rates went up, the appeal of Japanese bonds increased, and suddenly, investors were rethinking where they wanted to park their money. Japan's move to raise interest rates triggered a chain reaction. Investors, always on the lookout for better returns, began shifting their capital from US markets back to Japan. Why keep money in US bonds or stocks when Japan's bonds were now offering a better, safer return? This sudden capital shift caused a shakeup in the US financial markets. Let's break it down further. When investors pull out of US assets, it causes a drop in demand. And when demand drops, prices follow. This is exactly what we saw happen in key sectors of the US stock market. Tech stocks, already under pressure from rising interest rates in the US, took another hit as capital flowed out. The bond market wasn't spared either. As more investors dumped US bonds for Japanese ones, bond prices fell and yields, already a point of concern, started creeping up even more. Now you might be wondering, why is this such a big deal? Isn't this just normal market fluctuation? Not quite. The US stock market has been on a volatile ride for the past few years, with pandemic disruptions, inflation fears, and interest rate hikes by the Federal Reserve all contributing to the instability. Japan's unexpected policy shift added another layer of complexity. Investors were already jittery, and this move only amplified their anxiety. One of the most striking impacts was on the US dollar. As capital moved to Japan, the yen strengthened against the dollar. A stronger yen means Japanese products become more expensive for US consumers, which can dampen demand for imports from Japan. Conversely, a weaker dollar makes US exports cheaper, which could have been a silver lining, except that the uncertainty in the markets made it hard for businesses to capitalize on this advantage. The most immediate effect, however, was seen in market sentiment. Investors hate uncertainty, and Japan's policy shift introduced a lot of it. Questions about how far Japan would go with its rate hikes and how that would affect global liquidity started to swirl. This uncertainty led to increased volatility in the US markets, with sharp sell-offs in some sectors and erratic price movements becoming the norm. The climax of this situation came in late July and early August 2024. As Japan's central bank hinted at further rate hikes, the US stock market reacted with heightened volatility. The Dow Jones Industrial Average and the S&P 500 both experienced significant drops as investors weighed the implications of Japan's actions. It wasn't just about the numbers, it was about the broader implications. With Japan's rates going up, the cost of borrowing in yen became more expensive. This change affected companies and investors worldwide who had been relying on cheap Japanese credit. The global bond market, already sensitive due to high inflation and rising rates in the US, saw further disruptions. Bond yields, which move inversely to prices, rose sharply as bond prices fell. This shift hit the tech sector particularly hard. Tech companies, many of which rely on low-cost financing to fund their growth, found themselves in a bind. The increased cost of borrowing meant that these companies would have to either cut back on expansion plans or face higher interest payments, both of which could hurt their bottom lines. As a result, tech stocks saw some of the steepest declines during this period. But it wasn't just tech. Financial stocks also took a hit. Banks and financial institutions, which are deeply intertwined with global capital flows, faced uncertainty about how Japan's policy changes would affect their international operations. The ripple effects were clear. What started as a policy shift in Japan was now causing tremors in the US financial system. In the days following these market upheavals, reactions were mixed. On one hand, some sectors like utilities and consumer staples saw gains as investors sought refuge in more stable, dividend-paying stocks. These sectors are typically less sensitive to interest rate fluctuations, making them attractive during times of uncertainty. On the other hand, the broader market was struggling to find its footing. The Federal Reserve, already under pressure to manage inflation without stifling economic growth, now had to consider the global implications of Japan's actions. There were concerns that if Japan continued to raise rates, it could force the Fed's hand, potentially leading to more aggressive rate hikes in the US. This scenario created a feedback loop of uncertainty, where investors were unsure whether to brace for higher rates or hope for a stabilization in the global financial environment. The market's response to this uncertainty was telling. We saw increased volatility, with the VIX, often referred to as the fear gauge, spiking to levels not seen since the early days of the pandemic. Investors were on edge and market sentiment was fragile. Amidst this chaos, analysts began to speculate on the long-term implications. Would Japan's actions lead to a prolonged downturn in the US markets? Could this be the start of a broader financial crisis? While no one could say for sure, the consensus was clear: Japan's monetary policy shift had introduced a new level of risk to global markets, and the US was not immune. So where does this leave us? Japan's decision to raise interest rates has shown just how interconnected our global financial system is. What might seem like a small change in one part of the world can have far-reaching effects, especially when it comes from a major player like Japan. The US stock market felt the impact immediately, with increased volatility and uncertainty becoming the new norm. As we move forward, it's essential to keep an eye on how Japan's policies evolve and what that means for global markets. Will Japan continue to hike rates, or will they pull back in response to global pressure? How will the US and other major economies respond? These are the questions that investors, policymakers, and everyday people will be watching closely. If you're curious about what happens next, be sure to comment below with your thoughts. Let's start a discussion. And if you found this analysis helpful, don't forget to like, share, and subscribe to the channel. Hit the bell icon so you never miss an update on the latest market trends and global economic shifts. Thanks for watching, and stay tuned for more insights.